Girish, how many participants are there? And you share that admin link also to me. Good afternoon, friends. We are very lucky that today this is a second webinar of CECL and EA committee. Or everyone, including speakers, ask me what is this CECLEA. CECLEA is the whole planet, whole world. It is a committee on economic and commercial law. So there are 1300 central laws, and each state has a state laws. Like larger state has a more number of laws. Maharashtra has about 600 laws. The smaller states and new states may have a few number of laws, say Mizoram, and those northeast states has a few laws. So this is one big opportunity because the chartered accountant started interpreting the law much earlier, because we had before Income Tax Act 1961, Income Tax Act 1922, and we interpreted comma, full stop, inclusive definition, exclusive definition. So our interpretation knowledge, the complex laws, is very good, equal to other respected professionals. So today's one topic which Tarun Mahajanji from Indore is talking about is a law subject. Law, economics, commerce. Because the birth is under chapter, I was reading, there is only one section, section 247. In chapter 17 of the Companies Act 2013. And then there are rules for registered valuers. So registered valuers under Companies Act, under IBC, and there is a separate bill coming for valuers. So like chartered accountants, cost accountants, actuary, there will be a separate institute for valuers. So this is and valuation is required for everything. For a divorce settlement also, valuation is required. For admitting a partner, valuation is required. Before private equity put a investment into a business, valuation is required. So valuation is required for everything. We should do also our valuation when we render our services to our client. What is the value of our time? So this is one topic which Tarun Mahajanji from Indore will take. Another very interesting topic, I was learning from Yogesh Kulkarni ji, and he did not at a time, we were learning dashboard. So there is a small legislation called Information Technology Act 2000. And we have another law coming in technology called Personal Data Protection Bill, which is pending since 2019. And after Joint Parliamentary Committee report, it will be Data Protection Act, because this will cover both personal and non-personal. Now this platform, today, we are on Thursday, we are meeting. Otherwise, we will have Friday. So tomorrow we'll play Color Holi. So I thought let us learn on Thursday and then play the Holi with more confidence. So the Friday and Saturday are the learning day. And slowly I want to add all other days, Monday, Tuesday, Wednesday, of different other committees where I am a member. So, and learning, how learning happens. I have always spoken on a topic where I don't know anything. Not on the day of speaking, but on the day of agreeing to speak, which is 2 months prior or 3 months prior. I have written a book on which I did not know anything. There is a book called, I'll show you that. Search that book, and that book is on LLP, which was written in 2004. LLP Act came in 2008. But in 2004, Ministry of Corporate Affairs issued a concept paper on LLP. So I saw LLP in UK, US, and other countries. So we should be ahead. We should learn the subject as soon as the subject takes a birth. So we will have reasonable time. By the time the subject will be applicable to the whole industry, whole business, we will have a very good knowledge. And therefore, in our repetitive email, we say, please become a speaker. You just decide, rest you leave to us. We will tell you what to read, how to start a speaker. Like, from today, for the whole team, we have started a public speaking training session. If you want to write a background material, Institute has a scheme where we give 500 rupees per page. So you become a speaker, you become writer. There's a concept called thought leader. जो दिखता है, वो बिकता है. तो दिखने के तरीके क्या है? क्या तो आप लिखो. So there is a book available in the market which is an audit evidence. No better evidence will give a professional work. And second is, you use social media, put your video on YouTube, Facebook, LinkedIn, Twitter, Instagram, blog, website, and Pinterest, so many things. We will train you. Perhaps we will have once in a month, one session, how to use social media. Yogesh Kulkarni ji has done that. So, and learn new things which others don't know. Dashboard. Now, when I see all government websites, they have a dashboard. So, I'm telling in Institute why we don't have a dashboard. Everything comes in one graph, one picture. So, please unleash your potential. Come out of your beliefs and myth that you can't write, that we can't speak, I can't master in the global areas. We have made a list of 20 global areas. We will have one session. And, I am also given in charge of a group. How to make Indian firms global firms. So we will have Indian multinational accounting firm having presence in 191 countries. So please write to, I have unlimited time, write to me. We are so lucky that I have Madam Salini Gulati as a secretary of CECLEA Committee, Sri Ajit Tiwari as a committee of CPEC, Continuing Professional Education Committee. And we have Rohit Kumar in the central distribution system. So we want to send the knowledge seamless. And we have Dr. Salim Khan, who is coordinating activities at Bombay. So let us seize opportunities, and opportunities are seized by taking responsibility, by volunteering yourself. So I'll stop here because we have two stalwarts to share their knowledge with us. So over to you, Dr. Salim, to introduce the first speaker, and be very brief. Take only 2 lines, so because we want to hear more of them. And Yogesh ji, we will be listening him today as well as day after tomorrow.
Right.
Thank you.
Thank you so much, sir. Very enlightenment from your end. And really, what you said that, what you're going to tell, we are going to celebrate Holi with more intensity after getting the knowledge from you. And CA RV Tarun Mahajan and CA Yogesh Kulkarni are going to be an add-on to it. So moving on to our next speaker, CA Tarun Mahajan. CA Tarun Mahajan is a practicing chartered accountant. He is an All India ranker in CA exams, and hats off to you, sir. He is also a valuer registered with IBBI. For your information, IBBI is Insolvency and Bankruptcy Board of India. As sir said, you valuers need to have an association, and he has an association across India for the same. He has been part of research committee on valuation set by the Ministry of Finance, Government of India. He is also a qualified CFA from USA. He is first from the Central India to qualify the same. He is a national level faculty for valuation course and has taught valuation to more than 3,500 participating chartered accountants, CS and CMA. He has been a speaker and author with Valuation Standard Board of ICAI. So moving ahead to CA RV Tarun Mahajan. So please carry on, sir.
Yeah, there are 951 people on this webinar, and I feel that more will join. And there are few questions, Tarun, before, I can see them, some of them. 1 minute. There is a Chandra Prakash Gupta from New Delhi. Yes, putting a comment there is a question on preferential allotment of equity shares, which you can see later. And that's all. Over to you, Tarun.
Thank you. Thank you, sir. First of all, I would like to thank you, Dr. Rajkumar Adukia, sir, for giving me this golden opportunity to interact with my professional brothers and sisters. Thank you, sir. Thanks a lot. Thank you, Dr. Salim Khan, for being here and, coordinating the whole program. And now I would directly come to the point regarding valuation of securities and financial asset. Under the Companies Act 2020.
Put a focus on the speaker. All others, we should be hidden.
So I have started sharing my screen also. All right. Fantastic. Okay. So, my dear friends, actually, as far as this valuation is concerned, it's a comparatively new area. Getting done the valuation by a registered valuer became compulsory from, I can say, April 2019. So I will say this area is, it's just 3 years old approximately. So this is how there are many queries with regard to this area, which we call as valuation. And here I would like to discuss with you some of those things for which many people actually, remain confused that what exactly should be done for the sake of valuation. If there are any queries, please feel free to post your queries here in the chat box. And definitely those queries will be communicated to me, and I would love to address more and more queries from your side. Now, as far as this valuation is concerned, there are valuation requirements of shares and debentures and other convertible securities under the Companies Act, Insolvency and Bankruptcy Code, Income Tax Act, Foreign Exchange Management Act, and the Security and Exchange Board of India guidelines. But in today's session, we are going to focus only on the requirement of valuation under the Companies Act 2013. And definitely in sessions to come, we'll discuss more on valuation. So first of all, every practicing chartered accountant need to know that what are the various sections of the Companies Act 2013 under which a valuation is compulsory, under which a valuation is mandatory. So already one query has been put by somebody regarding preferential allotment of equity shares. So I would first come to that point and then we will discuss. if I quickly read these bullet points, so valuation requirement is under section 54 for sweat equity share, under section 62 for preferential allotment of equity shares, under section 67, which is related to buyback by making a trust for creating a pool of equity share for employees, under section 192 for dealing with directors, and under section 230, 232, 234, 236, which relate to merger, compromises, and arrangements, and at last, under section 281. These are some of the prominent sections. So in fact, more and more valuation work is generated under section 62, subsection 1, clause C of the Companies Act 2013. And that's why I start my discussion here, and later we can cover the point related to sweat equity shares also. Now, my dear friends, let me tell you one first very important thing, that whenever a valuation is required under the Companies Act 2013, that valuation, whether it is a valuation of securities, or it is a valuation of land and building, or it is a valuation of plant and machinery, whenever a valuation is required under the Companies Act, the valuation must be done by a registered valuer. When I say registered valuer, means a person who is registered with Insolvency and Bankruptcy Board of India. So it's an emerging professional opportunity for all practicing chartered accountants. For this, you need to get yourself registered with IBBI, then attend a 50 hours online, offline, whatever type of training is there, which is conducted by ICAI RVO, the Institute of Chartered Accountants of India, registered valuer organization. And once you complete the training, you need to appear in the 2-hour computer-based examination. And if you clear the examination in first shot, register yourself as a member of ICAI RVO, and as well as you get the certificate from IBBI, and you become eligible to give valuation certificate, to give valuation report under the Companies Act, under Insolvency and Bankruptcy Code, and as well as under some of the guidelines of Security and Exchange Board of India. So first of all, you need to have a clarity on this particular aspect. Now, let's talk about what are the requirements. So the most important thing here is section 62, which talks about preferential allotment of shares. So first of all, valuation is compulsory. So if there is a private company, or if there is any unlisted public company, and it wants to make preferential allotment of its equity shares, or in simple words, it wants to make private placement of its equity shares, in that case, okay, just a moment. If it wants to make preferential allotment of its equity shares, in that case, a valuation report by a registered valuer is compulsory. Now, suppose you go to a registered valuer, or suppose you are a registered valuer and you are getting an assignment to make allotment of equity shares, then first of all, you have to choose an appropriate method of valuation. Valuer cannot simply certify net worth of the company. He'll have to choose either the income approach of valuation, or the market approach of valuation, or the cost approach of valuation. And ultimately, the purpose remains to calculate fair value of the equity share of the company, which is going to be privately placed to few selected investors of the company. So this is one thing. And suppose valuer certifies that this 10 rupees face value of share has a worth of 200 rupees, then company can issue this share through private placement on preferential basis only at a price of 200 rupees, or at a price higher than 200 rupees. If registered valuer certifies that the share value is 200 rupees, company cannot make allotment of its shares below a price of 200 rupees. This is one thing. A question arises, what if the company is making preferential allotment of equity shares for a consideration other than cash? Like the company is acquiring running business of a proprietorship, or the company is acquiring running business of a partnership firm. Many people want to take advantage of the exemption given under Section 47 of the Income Tax Act 1961, where if the entire business of the proprietorship is transferred to a company, or entire business of a partnership firm is transferred to a company, and the ownership doesn't changes and several other conditions are fulfilled, there is no capital gain tax liability in the hands of proprietor, partners, or partnership firm. So many people want to take advantage of this, and this is how a company allot equity shares on preferential basis for acquiring a whole business. So if a non-cash consideration is there, in that case, actually two valuations will be required. One is what is the fair value of equity share of the company, and the other one is what is the fair value of the business which company is going to acquire. Two valuations will be required. One, valuation of equity share of the company. Two, valuation of the business which company is going to acquire. So there is a question. So there is no way to avoid a valuation. There is only one situation where valuation of equity share by registered valuer will not be required, and that will be right issue. Suppose there are 3 members in a private company, and those 3 members are holding shares in the ratio of 40%, 40%, and 20%, Mr. A, B, C. And if company comes up with a right issue, so right issue means existing shareholders are allotted equity shares in the company in the same proportion in which they are currently holding the share. In that case, there is no requirement to get a valuation certificate from a registered valuer. But keep in mind, allotment should be done to existing shareholders, number one. And number two, very important thing, in their existing proportion of equity shareholding. So this is the situation where you won't need the valuation report. But what if company is making allotment to those 3 shareholders only, but not in the ratio of 40%, 40%, and 20%, rather than it is planning to make allotment in the ratio of 30%, 30%, and 40%, then precisely this is not the right issue. And in this particular case, valuation report will be required. Now, sometimes the entrepreneur or the business owner tries to make a planning how to avoid one extra formality of getting a valuation report. So I have came across some situations like this. They say, okay, let's do one thing. Let's give right offer to existing shareholders in their existing proportion. And then they will deny the right offer as per the pre-planning. And once the right offer is denied, Section 62 clearly says, now it is at the discretion of board of directors to allot those shares in the best interest of the company the way they feel appropriate. So my personal opinion in this case is, if somebody is planning that, okay, we'll give the right offer, members will deny the right offer, now the board will make preferential allotment to somebody, hence we won't need the valuation report. So in my opinion, that's absolutely wrong. Even in that case, a valuation report will be required. Right. There can be one more situation where a valuation report won't be required, that the company makes right issue and the shares are allotted and the shareholders who got the right offer, they renounce their right in favor of any other person. But keep in mind, this planning under the Companies Act can become burdensome under the Income Tax Act, because renouncing the right is like selling the right. And if you're selling something, you will be liable to pay maybe taxes under the Income Tax Act. So be careful while doing something like this. Right. One more situation which is given under section 62(1)(c) is valuation is required even if company is planning to offer employee stock option scheme shares to the employees of the company. So actually, nowhere in the Companies Act it is directly written that for the purpose of ESOP, you need a valuation report. But for the sake of accounting of that ESOP, you definitely need a valuation report from a registered valuer, because ICAI has issued guidance note on how to make accounting for ESOP. And for that purpose, you will need a valuation report by the registered valuer. When the employees will be exercising their stock option, at that time, again, a valuation of equity share of the company will be required under the Income Tax Act, but that valuation should be done by a merchant banker. Now, interestingly, so in this particular slide, we were talking about unlisted equity. Now, let's talk about listed equity. What if the equity shares of a company are listed on any recognized stock exchange? And now company is planning to make private placement of its equity shares. Do we need a valuation report here? So answer is yes as well as no. If the shares are frequently traded, listed shares are frequently traded, in that case, you don't need a valuation report. But valuation is required if the shares are infrequently traded. Unlisted equity, every time you need a valuation report, you make a private placement, you make preferential allotment. Listed equity, if it is frequently traded and your company wants to make private placement of equity shares, you don't need a valuation report by registered valuer. But listed equity, where the shares are infrequently traded and the company is planning to make private placement, preferential allotment, in that particular case, again, a valuation report by a registered valuer is very much required, even under the SEBI guidelines. What do you mean by shares which are infrequently traded? So here, infrequently traded shares means the number of shares traded in last 12 calendar months are less than of the total number of shares of that class of shares issued by the company. In that particular case, you will require a valuation. I'll give you one example for the same. So today it is 17th of March 2022. And suppose today your company wants to make preferential allotment of its equity share, and the company is listed on stock exchange. So you need to check turnover of the share on stock exchange for last 12 calendar months. So last 12 calendar months means the months ending on 28th of February 22 and beginning on 1st of March 21. So from 1st March 21 to 28th of February 22, you'll have to check the turnover of your share on the stock exchange. Suppose number of shares which are issued by your company are 1 crore. Say the number of shares which are issued by the company are 1 crore, and suppose traded number of shares of the company are 9 lakh. So issued share capital of that class is 1 crore number of shares, while in the last 12 calendar months, total number of shares traded on the stock exchange were 9 lakh. That's the 9% trading of issued capital. So I will say that the shares are infrequently traded, and for making preferential allotment, a valuation report will be required. If number of shares changes during the year, then 10% should be calculated on opening number of shares or closing number of shares. And the answer is no. You will have to take weighted average. So let's take an example that on 1st of March 21, that is the beginning date of this block of 12 months, was suppose 1 crore number of shares were there. But after 6 months, that is on 1st September 21, company issued further 1 crore shares. So ultimately on 28th of February 22, total 2 crore number of shares were there. So now I need to calculate 10% of 1 crore or 2 crore. And the answer is you need to take weighted average. These 1 crore number of shares remained there for whole 1 year. So I will I'll multiply it by 1. And these 1 crore number of shares remained there for September, October, November, December, January, and February. That is 6 months time period. So half a year it is. 1 crore multiplied by a whole 1 year is 1 crore. And 1 crore multiplied by 0.5 year is 50 lakhs. So total number of weighted average number of shares of the company are 1 crore 50 lakh, my dear friends. And now, if the turnover is less than 15 lakh number of shares, in that case, I will say that the share is infrequently traded, hence a valuation report is required. When I say stock exchange, it means the stock exchange where the highest trading volume in respect of equity shares of the issuer has been recorded during the preceding 26 weeks prior to the relevant date. Suppose the equity is listed on BSE as well as NSE. So check the turnover on BSE for last 26 weeks, roughly 6 months, as well as NSE for last 26 weeks, and take the turnover from the stock exchange where the trading volume is comparatively higher. So suppose share was traded at both NSE and BSE, and in last 26 weeks, turnover at BSE was suppose 4,50,000, 4 lakh number of shares, and turnover at NSE was 4,20,000 number of shares in last 26 weeks. Therefore, I will say that I will take the turnover of NSE. And now turnover at NSE for the equity share for last 12 calendar months was 9 lakh. And suppose 1 crore 50 lakh, or suppose 1 crore shares are there. So in this case, I will say 9% is the traded volume. Hence the share is infrequently traded, and therefore a valuation of equity share is required. Now let's come to the frequently traded equity also. So the equity share of the company is listed on the stock exchange and it is frequently traded, that is the trading volume is 10% or more. And if this company is planning to make preferential allotment of its equity shares, like last year, one of the bigger example of such situation is PNB Housing Finance last year allotted shares worth rupees 4,000 crores to the Carlyle Group, which is a private equity investor group. So PNB Housing Finance was a listed company and it was making preferential allotment to the group of shareholders of Carlyle. And now the share was frequently traded. As per SEBI guidelines, in this case, you don't need a valuation report, but a floor price has been decided by SEBI. Floor price. SEBI doesn't give the valuation formula. It gives a floor price that you cannot issue shares on preferential basis below the floor price. The floor price should be low, at least higher of the two. Average of weekly high and weekly low of volume weighted average price of last 26 weeks, and average of weekly high and weekly low of volume weighted average price of last 2 weeks. See, I'll give you one example. Like this is 1 week from 31st May 21. Let me zoom it in so that it will become convenient for you to watch. 31st of May to 4th of June, this was 1 week. So for each day of the week, you have to take the weighted average price of the day and then choose the maximum of the weighted average price. Maximum is 152 and minimum is 144. Take the maximum, take the minimum. First of all, you take weighted average price for each day. Then you choose the maximum and minimum weighted average price from the week. And then you calculate average of this maximum and minimum, which is 148 rupees in this case. So this is 1 week data. Now you do it for second week, you do it for third week, and keep doing it 4, 5, 6, 7, 8, 9, 10. Do it for 26 weeks. And then calculate average of these weekly averages. 26 weeks average you take. Suppose that is 133 rupees. Last 2 weeks average also you take. Suppose that is 150 rupees. Whichever is higher. In this case, 150 rupees is higher. So your issue price cannot be less than 150.52 rupees. Interestingly, here average is taken 3 times. Number 1, average of the day, then average of the minimum and maximum of the week, and then average of various weeks. Based on that, you decide a floor price, and you can issue shares at a floor price or a price higher than the floor price. In this case, you don't need valuation report of a registered valuer or by anybody. But as a good governance practice, companies usually take a valuation certificate, in this case, either from practicing CA or from a registered valuer. Now, there is one very interesting question. We are seeing a startup culture. A whole startup ecosystem is working across the country. Even you might have seen one of the reality shows, Shark Tank. And if you are into startup ecosystem, you must be already aware that a lot of startups are working and a lot of funding is happening for startups, whether it is the angel finance or it is the the mentorship finance, or it is the rounds of venture capital funding, or it is the private equity funding, and finally they come up with the public issue. These startup financiers, when they buy shares in the company, most of the time they don't directly buy equity shares in the company. Rather than they prefer to buy some complex hybrid instruments, because the investor is taking huge risk. So they want to protect their interest properly. And that is why they subscribe in some of the very complex securities. Being a valuer, I am witnessing many such complex securities. I keep on doing various types of valuation, startup valuation, intangible asset valuation, n number of valuations I'm doing. Startup valuation also, I'm doing a lot of startup valuation I'm doing. And every time I see a new type of instrument. If some people call me and say, sir, I want to make valuation, can you tell me the steps? I'll say every single valuation assignment will be a different challenge. They enter into the term sheet, they make the shareholder agreement. And sometimes this shareholder agreement runs into, 80 pages, 90 pages, 100 pages. And many types of conditions are given regarding the voting power, the tag along, the drag along right, and the liquidation preference and default event and what not. So they design very complex securities, and the valuation also becomes challenge for the same. So company can issue compulsorily convertible preference share, CCPS, optionally convertible preference share, OCPS, compulsorily convertible debentures, CCD, optionally convertible debentures, that is OCD. And the question arises, do we need a valuation while issuing CCD, OCD, OCPS, CCPS? And my answer is yes, very much. A valuation is required in this particular case. But the question is, when do I need a valuation? At the time of issue of these securities, or at the time of conversion of these securities into equity share, or I need a valuation report at both the times, or I don't need a valuation report at all. So I'll give you a broad guideline. In case of more complexities, we can discuss it personally. But the broad guideline is like this. If a conversion ratio has been decided that this preferential or this debenture will be converted into 2 equity shares or 5 equity shares or 10 equity shares, if the conversion ratio has been decided at the time of issue of convertible securities, then a valuation report is required at the time of issue of that security itself. So when you will be filing PAS 3 form with the ROC, the valuation report must be attached to that PAS 3 form, right? But suppose the conversion ratio is not pre-decided and it is written that this CCPS will be converted into equity shares of the company after 5 years at the fair value prevailing at the time of conversion. So you subscribe 10 crore rupees of preference shares and number of equity shares are not decided today. Rather than after 5 years, whatever fair value of equity share is there, accordingly number of equity shares will be allotted. If conversion ratio is not pre-decided, rather than the conversion ratio is left on the fair value at the time of conversion, then I will say today you don't need a valuation report for issuing those convertible securities. Today you issue it at par or whatever price is there, and at the time of conversion, a valuation report will be required. So this is the broad guideline, but otherwise security to security, you will have to check. If you face any such situation, better you take advice of the registered valuer and he will better guide you for this. Now, there is a question regarding, buyback. One interesting question I would like to address before I go to buyback. See, suppose you are making valuation of a company which is covered under Ind AS. Now, in Ind AS, at many places it is written that the accounting should be done on fair value. So if the accounting is to be done on fair value, the question arises, what is the fair value of this particular asset or liability? Who will make valuation? So earlier, whatever management's declaration was there, auditor used to accept it. Management said, okay, we have bought equity shares in unlisted company and this seems to be the fair value. And auditor said, okay, fine, I have checked your calculation, that's fine, and I accept it. Later, after emergence of Ind AS, the scenario changed and auditors started insisting on the management that you take the valuation report from any independent professional. So let's talk about year 2018 when this registered valuation concept was not there. So an independent chartered accountant was appointed by the management, was used to be appointed by the management, and he will calculate fair value. He will submit his report to the company and company will produce it to the auditor, and auditor can have a hygiene check of that report. And based on that, he will accept the fair value which is used for the purpose of accounting. But if you read section 247 now, some people say it's a gray area, but I personally feel that this is not a gray area. Valuation under Ind AS should be certified by registered valuer. Look at this. Just a minute. Okay, one question has been posted. I would like to answer it. In case of preferential allotment of equity shares, existing members renounce his right to a non-member, whether a valuation of share is required from a registered valuer or chartered accountant. Company secretary is asking for CS certificate. So, sir, actually, if the right is renounced, then I think that a valuation certificate from the registered valuer is not required as per the provision of the law. But as a good governance practice, it is always advisable to get done the valuation by the registered valuer. Because ultimately, this is how the company is trying to avoid the valuation report by first making the right issue, and then the right is renounced in favor of a non-member. And you're trying to bypass the provision which is written in the law. If we look at the intention of the law, intention is very clear. So legally, no valuation is required, neither by a chartered accountant nor by a registered valuer. But as a good governance practice, it should be valued by a registered valuer. Okay, so you can keep asking questions while I'm continuing this. So we were talking about valuation for the purpose of Ind AS. Look at this. Section 247 says that where a valuation is required to be made in respect of any property, stock, share, debenture, security, or goodwill, or any other asset, herein referred to as the asset or net worth of a company or its liabilities, under the provisions of this Act, it shall be valued by a person having such qualification and experience, registered as a valuer, in such manner and on such terms and conditions as may be prescribed and appointed by the audit committee, or in its absence by the board of directors of the company. What does it say? Where a valuation is required to be made, it must be made by the registered valuer under the Companies Act. Now, whether it is accounting standard or it is Ind AS, it is notified under Section 133 of the Companies Act. Central government has the power to notify AS and Ind AS in consultation with NAFRA. So, AS and Ind AS are given as a part of rules to the Companies Act. Rules are very much part of the Act. So, if under Ind AS, a fair value accounting is required and a fair value calculation is required, ultimately you are adhering to the provisions of Section 133 of the Companies Act. And Section 247 says that whenever a valuation is required under the provisions of this Act, then it must be done by the registered valuer. So my personal opinion is, if you are an auditor of a company and the company is covered under Ind AS and a fair value is required anywhere in the accounting of the company, you must insist that the valuation should be done by a registered valuer. Many times people keep asking this question, that what if the shares are transferred? Mr. X is transferring his share to Mr. Y. Is a valuation report required under the Companies Act? And the answer is no. Valuation is not required under the Companies Act. But it may be required under the Income Tax Act. But today we are not discussing those points. One more question has been posted. In case of gift of shares of private limited company from one family member to another, question is, do we need any valuation under the Companies Act or Income Tax Act? As per my understanding, I don't think we need any valuation. And the question is how to calculate share transfer stamping in case no valuation is required. Very good question, sir. First of all, whether it is a transfer of share for consideration or transfer of share without consideration, that is gift, valuation is not required under Companies Act 2013 at all. Number 2, under the Income Tax Act. So now you'll have to refer section 56 to 10B, 210. And 56 to 10 says that if you're receiving something without consideration from a person who is your relative as defined in that particular section, then it is not taxable in your hands. Therefore, again, a valuation is not required. But a question arises that how do we pay for the stamp duty? So under Stamp Act, you will have to judge the value of the company based on what is the prevailing market practice for the same, right? Maybe the company is having a immovable property. Suppose the major asset in the company for which you're gifting the share is any immovable property, right? So you need to check the circle rate or the guideline value or the stamp duty value of those properties. And accordingly, you can decide the value of the share, and accordingly, it may be subject to stamp duty. But let me clarify you one thing, that for the purpose of stamp duty, registered valuers are not authorized to make valuation. Does issue of share warrant by private limited company need valuation? So probably there are two types of warrants as I understand. One thing was share warrant under the erstwhile Companies Act 1956, where the shares were transferable by delivery only. I think you're not talking about that. Probably you are talking about the warrants which are issued by the company to its managers. Or you're talking about debentures with warrants. I guess because that is the practice. Debentures with warrants may be there. Warrants of the company may be given to the executives also. So warrant is nothing but right to buy equity shares in the company. Warrant is nothing but right to buy equity shares in the company. Okay. Now, right to buy equity share in the company, what does it mean? It means something really very simple. It is an option given by the company to somebody. And if you're giving the option, it is a valuation will be required. Like for ESOP, you need a valuation. For issuing convertible debentures, you need a valuation. And therefore, if warrant is issued by the company, where it gives an option to the warrant holder to buy equity shares in the company, a valuation is very much required to be done by the registered valuer. A question has been posted, is preferential allotment and private placement same? And yes, actually, I will say the private placement can be of two types. The private placement may be in the form of a right issue, or a private placement may be in the form of a preferential allotment. When I say preferential allotment, it means you are not making the right issue and you are making issue to some selected people who may or may not be member of the company. And even if they are member of the company, you are issuing shares in a ratio which is not their existing ratio. So I'll say preferential allotment means allotment of equity share to few selected people which are chosen by the board of directors of the company. Now, there is one interesting question, that how much fees is being charged by the valuer minimum. So, sir, actually, there is no such standard as minimum. First of all, it depends upon whether you are located in a class A city, metro city, or in a class B, class C city. Second, it depends on the volume of the work. The most important thing is actually volume of the work involved. If the company is really huge, then you need to check data in depth and the fees rises. And at the same time, I will say that if the complex securities are there, then also the valuation fees rises. There is no such thing like as the minimum fees which is charged by the valuer. But if you insist on some hardcore number, I'll say, 25,000, 30,000 rupees minimum for something, for a company which has, nothing, no more, nothing, complex things are there over there. But fee standard is not as such. Okay. Is valuation mandatory for transfer of share by non-resident to non-resident of Indian entity? No, sir. Now we are talking about FEMA. If the resident is transferring share to non-resident, or if the non-resident is transferring share to resident, in that case, valuation will be required under FEMA. And interestingly, that cannot be done by the registered valuer. That can be done by a practicing chartered accountant or CMA or the merchant banker. But resident to resident transfer under FEMA, no valuation required. Non-resident to non-resident transfer under FEMA, no valuation is required. But you will have to check it under Section 9 of the Income Tax Act, that whether it is indirect transfer of the ownership in the company, and is there any liability of withholding tax, which was the case of Vodafone India, where several thousand crores rupees of tax liability was imposed, and eventually they won the case. So under Income Tax Act, you will have to check it under Section 911, if I'm not wrong, of the Income Tax Act. But as far as FEMA is concerned, non-resident to non-resident, valuation will not be required. One more question is posted. Private placement in private limited company done at face value only, shares issued to family members of other shareholders, still valuation required. Now, this is very interesting, because many people have a confusion with respect to this. Sir, this is my family owned company. Me and my wife, we are two shareholders. Now my two sons have also become adult, and I want to introduce them to the company. So I'm planning to issue some shares to my sons also. So ultimately, before this allotment, it was all within the family. Even after this allotment, it will be all within the family. So we are planning to make allotment of shares at 10 rupees face value. Then do we need a valuation report? So first of all, let me tell you that if it is not a right issue, then even if you are making allotment of equity shares to the relatives of existing members or directors, a valuation report is very much required. Number two, a question remains always that I am planning to issue shares at 10 rupees. Do I need a valuation report? No. You will have to reverse it. You can't decide that you will issue shares at rupees 10. Number one, if a valuation report is required, other than right issue in all private placements, you need a valuation report. If a valuation report is required, you can't issue shares at rupees 10. If valuer says that this 10 rupees face value share is worth rupees 5,000, you will have to issue shares at or above 5,000. If valuer says that, okay, this 10 rupees of share is worth 3 rupees only, but you can't issue shares at a discount as per Section 53 of the Companies Act. So in that case, you will have to issue shares at par. So it's not like I am issuing at face value. Do I need a valuation report? No, you need a valuation report. And if it is above par fair value, you can't issue shares at fair value, sir. Okay, one more question has been posted. Only delivery traded to be considered for frequently traded shares if listed shares. See, the trading volume which is reported by the stock exchange is for delivery as well as non-delivery. So we'll have to take the total turnover, sir, whether it is delivery based or it is, the day trading. We will take the total turnover for past 12 months, delivery or non-delivery, both will be considered. One more question is posted. What are the valuation methods for valuation of equity shares? So let me tell you this thing, just a minute. Now, as far as equity shares are concerned, sweat equity shares are concerned, two valuation will be required. One is the valuation of equity share of the company, which is being given to the employee. And number two, valuation of the intellectual property right, which is contributed by the employee. Usually, sweat equity shares are given by the companies, which are into the service space, like the software company, consulting companies. They give sweat equity share in most of the cases I've seen, or where the managerial importance is very much and production and all those things are not really important. In these companies, they are usually, good profit making companies, or they have potential of making positive cash flow. So generally, I have seen that in these cases, income approach of valuation or discounted cash flow technique can be used, but I cannot say it absolutely. Case to case, it may differ. Income approach, market approach, cost approach are approaches, and you'll have to choose one of them. I have done several valuation of sweat equity shares, and I will say in all those cases, actually, circumstances were like that I used the income approach or the DCF method. One more question is posted, where can we do the valuer's course? So I would like to repeat it. If you want to become a registered valuer, first of all, you will have to choose any RVO, Registered Valuers Organization. There are roughly 14 RVOs in country. You can go to IBBI website and you'll get the list of all RVOs. But being a chartered accountant, I will advise you that to do this course with ICAI RVO. It will be better synchronization. So visit the website of ICAI RVO, get yourself registered over there. Contact numbers are also given. You call them, they'll give you full information. 50 hours of the training you will have to take, and then appear in examination, for which approximately 100 hours of further studies will be required in my experience. Can CA issue valuation report based on DCF for private company for normal term loan? DCF for private company for term loan. Okay, you're saying that I go to a bank and ask for a term loan, and the bank is saying that, but why the bank will ask for valuation of equity in that case? Definitely, you make a project report where future cash flows are there. And for bank loan, if any valuation is required, definitely chartered accountant can do it, or whatever the bank prefers. If you are not issuing equity share, you don't need registered valuer's certificate. Would issue of warrant need valuation? Yes, I have answered it. It will need valuation. So guys, if there are any other questions, please ask it. And if further query remains, you can connect me. Okay, one more question has been posted. In some cases of assessment, assessing officer asks the reason for the amount of the security premium. Does it will be an issue if share were issued above par but less than the value derived based on some valuation method in case of unlisted? Yes, sir. Actually, that's the based on income tax valuation. So the face value is rupees 10 per share. And suppose using the DCF technique or using the book value method, which is allowed under Income Tax Act, fair value is rupees 100. And you have issued share at rupees 120, then this 20 rupees become taxable in the hands of the company. But probably you are asking that a 10 rupees share for which the fair value has been calculated at 100 rupees and the share is also issued at 100 rupees, then under a scrutiny case, assessing officer has the right to ask the method used for valuation and do the check for the valuation that actually is the fair value 100. And if he says that, I think the valuation is not appropriate and the fair value should not be 100, rather than it should have been 70, then I in that case, definitely the valuer can explain his method of valuation. And if his method of valuation is perfect, even the Supreme Court has said that it is not the expertise area of any court to challenge the valuation done by the valuer if he has properly done the valuation. So even I think, if assessing officer challenges the valuation certified by a merchant banker in case of DCF technique, then definitely you can challenge his decision also. Can sweat equity be issued simultaneously with buyback? and how far value of both will be arrived. So let me tell you, for buyback of equity share under the Companies Act, valuation is not compulsory, but I have done at least 5 to 10 such valuation where the buyback form which was filed with the ROC was actually rejected, and they said they need a valuation report. So though it is not written under the Companies Act that for the sake of buyback you need a valuation report from registered valuer, but in several cases ROC is rejecting it. So it is, as a good governance practice, it is advisable to get done the valuation by a registered valuer. Salim sir, can I take...
This is the last question we'll take.
Okay, right sir.
Last question.
A running private company having net worth is nil, okay, and need to share on private placement, can RB on net asset value method is sufficient for allotment or go for valuation through merchant banker? Sir, if a private company is making allotment of share, merchant banker is not allowed to make valuation. Let me tell you. Under the Companies Act, merchant banker is not allowed to make the valuation. Only registered valuer will make the valuation. And if registered valuer feels that there is no business potential in this company in the future, then he will go with the asset method and accordingly he will certify the value. If more questions are there, my contact details are given over here. You can connect to me and you can post your questions over there, because our next learned speaker is also there with us, and therefore I won't take much time now. Thank you everybody for participating and asking interesting questions. Thanks.
CA Tarun Mahajan sir, thank you so much. Your session was really very enlightening, and a lot of things even I learned from you, and I'm sure the other participants also. And really you answered the questions very nicely, and I'm sure the question and answer session went very smoothly and very nice. And thanks for sharing your details so that, those participants whose questions have not reached, they can reach you. And thank you so much for that. Our next speaker, I'll just give a short description about CA Yogesh Kulkarni. He has been serving industry since 23 years with large MNCs in India, abroad, on the senior most coveted position of CFO and controller. Has started his entrepreneurship journey recently by forming a company. His area of expertise comprises of strategy rollout, financial engineering, global scaling up, PE funding and valuation, budgeting and forecasting, risk mitigation through GRC and SOX, driving financial process excellence and rolling out performance management system, or for revenue and OP maximization by connecting operations to finance. He is equally passionate trainer, and he brings with him an array of impressive knowledge, skills, of expertise to impart to the participant in this training program, which create an everlasting impact in their minds. His mission is to help and support individuals and organizations in achieving professional excellence in integrated global financial systems. So, sir, the desk is yours. Please go ahead and enlighten us further.
Thank you very much, Dr. Salim, for the kind words of introduction. I want to take this opportunity to thank Dr. Rajkumar Adukia, sir. He has been very instrumental in taking all these great new initiatives, and I really appreciate he wanted me to bring onto this table something which is unique, which can be one of the line of practice for most of the chartered accountants. So I'm just trying to share the screen, and we can take it further from there. Dr. Salim, please let me know if the screen is visible, so that 1 minute. I think I need to share it along with the sound.
It is visible.
Otherwise, yeah. I'll just need to share the screen along with the sound for a minute. Yes. Dr. Salim, is the screen visible?
Yes, sir, it is.
Yeah. So thank you, everyone. I'm very excited to participate in this VCM. And today I'm going to talk about something which is unique, which is one new line for all of us, which is finance excellence. My passion has started from business excellence, and I have customized this finance excellence as one more method or one more journey, which you can say a new area which I wanted to explore. And this today, what I'm going to talk is about how the corporates and how the chartered accountant for their offices they can drive this. When I say corporates, it is definitely the corporates and for the organizations who are the clients for the chartered accountants, and for CA offices themselves, they need to drive the finance excellence. So as you can see that if at all you want to drive any kind of an excellence, it's a process, or you have to carry out it with the baby steps. And that's why you see at the end I've tried to mention crawl, walk, run, and instead of jump I'm mentioning it as a fly. So these are the baby steps. Any excellence journey is not something which can happen overnight. It has to go through the baby stages of development. So if it's a crawl, then you need to crawl properly. If it's a walk, you have to walk properly. Without properly crawling, if you start walking, then probably you will fall down. And that's how the excellence journey we need to drive it within the organizations. So I'll skip this introduction. I was CFO and worked with a couple of companies on the leadership roles, and ventured into the practice just 2 years back. So one of the most important function which all of the finance team member which they need to think about is this business code. And this business code is by Jack Alexander, who is FP&A expert. He's a consultant author. And what he mentions is that finance function loses the potential to steer their organizations to success when they defer performance management to other functions. What does it indicate is that usually there is a tendency that every person who is finance function, he says that I'm only concerned about the finance as a department or finance as a function. Let the operation do their activities and it's none of my concern. Okay, I will only take care of it when it comes to the finance. And that's where the fight starts. That's where the importance, gets reduced. You hear quite often in every organization, in the corporates, this word is quite often spoken that always salespeople are given more importance than the finance guys. Most of the operations people, they get more importance because practically they are the one who are producing the goods, or, who are on the operation side if it's a service industry. And when it's a sales side, they are given the highest importance because they bring the sales, they bring the revenue. And finance is treated more like a regulatory function. Okay, some regulation has given you power, so you people are, doing some work. And they are only thought that they are more like a nuisance. They are treated like, their job is only to take objections, do the audits, and that is how the usual tendency is. But if you see, you want to gain the importance in every organization, one thing what you need to do is understand the operations. And if at all you have to understand the operations, you need to connect operations to finance. So the most successful people who are taking the leadership role in the finance, they are effectively connecting the operations to the finance. And this business code also mentions that when you say that connecting is something like an IT responsibility, or presenting the performance report of a let's say sales function or operations function, it's the job of a IT or it's job of that respective operation on sales, then your importance is lost. So performance dashboard and analysis for value creation is the book from where this quote has been taken. Now it's very important that we need to understand in last 2-3 years whatever has happened in this globe, and how the finance function, its importance has enhanced, and what exactly finance as a function need to do, and what as a chartered accountants we need to do, so that we scale up ourselves, we scale up our clients. So I just want to tell you about the brief facts about the importance of the finance function and what it is mentioned worldwide. So Blackline is one of the organizations which has surveyed a lot of US business decision makers, and they have done some research that what is the importance of the finance guys, which is felt by the all communities globally. So 60% of the people, they said that during the survey, if any company is having sound financial practices and systems, which are most important for well-managed growth. So if at all you have to manage the growth in a well manner, then 60% of the people say that sound financial practices are important. Whereas 31% people believe globally that improved efficiency in financial management is the most underrated part of their business. So most of the people say that yes, when it comes to driving the operation, it's like you bring some IoT devices, you bring something great, in the organization whereby your production ramps up. Okay, whereby you introduce some scheme whereby your sales ramp up. But if at all you have to talk about improving the financial management and the systems and the efficiencies, for that the investment has to be done. Then 31% people say that yes, it's not like given the focus. 43% people say that financial teams contribute to the growth of a business beyond financial management. And one of the most important aspect is many of the companies now they started having earlier CFOs started becoming the CEOs, because we all chartered accountants, we understand money and number language very well. Okay, so we know that what is going wrong. So that's how 43% actually contribute to the growth of the business. 59% describe that the persons in their business that rules finance as the business leaders. So most of the people feel that yes, only finance people can be the business leaders. 59% people believe that. 52% agree that the finance teams can be entrepreneurial in the way they help business grow. So we finance guys need to think as if like we are entrepreneur for that business. And when we start thinking like that, then only the business grows, and finance people have all these capabilities. Now, I just want to showcase one of these video, and through this video, I just want to tell you the importance of the finance guys. How was the finance function, 3 years back, 4 years back, 5 years back, and how is the finance function currently, and what's going to happen for the finance function. And now when I'm talking about the finance function, think about your CA office itself as a finance function within your CA office and for your clients. So this video talks about 2 scenarios. One scenario where finance people, they decided that they want to totally transform the organization and do all the changes within their finance as a function. And the another scenario talks about the people, they kept doing the same traditional work, pursued same traditional way and methodology of doing the things and practicing the things, and what happened to them. So I'm just playing this video. And this is from Deloitte. It is on YouTube.
Digital transformation opens the door for many opportunities within finance. Today, finance is asked to essentially set the course for the years to come. Let's take a closer look at 2 possible scenarios for the future. We're in the year 2022. Finance as a division has significantly shrunk. In many areas, standardization and automation have taken place. Many processes have been automized efficiently through robotics. Finance consists of a small team of specialists for topics like IFRS, taxes, risk management, compliance, regulation, and financing mechanisms. Processing of financial statements is now fully automated. The operational responsibility for the closing process is now owned by IT. Business decisions are primarily taken based on information derived from operational functions. Marketing and sales, as well as technology, invested early in big data and analytics and are now jointly leading the Center for Analytics. Finance has lost its leading role and is no longer involved in important decision-making. Instead, it focuses on contributing special expertise where needed. The responsibility of planning and forecasting has shifted completely towards operations. Early on, they set up big data-based prediction models within their divisions. The role of finance is limited to planning of financial mechanisms, taxes, as well as currency and consolidation effects. Finance has become a mere center of excellence that is limited to providing highly specialized financial expertise upon request. 2017. Finance missed the opportunity to claim and shape new digital trends and actively build a future vision for themselves. Finance was overrun by digitalization and lost its role of being part of the strategic development of the entire organization. 2017. Finance decided to become a leading pioneer of digitalization. Finance analyzed digital trends for themselves and developed a target and vision for the future. The goal was to act, not react, and develop a common vision. Upon this foundation, new opportunities were identified, and as a result, a newly formed roadmap has been developed to define specific actions for the years to come. An interdisciplinary team coordinates analytical topics and combines deep business competence with technical know-how. Finance was the driver for building the Center for Analytics. Information from various sources are combined in real time. The planning and forecasting process has been automated to the highest degree possible with modern statistical methods and big data. The forecast preparation is done by a push of a button, and finance is able to focus on the development of new insights. From day one, all finance executives have been involved in the development of the target vision. Finance now combines strategic competence with in-depth business know-how. New skills in the area of data modeling and analytics have been built up and used successfully. Finance focuses on cross-functional and interdisciplinary cooperation. 2022. Standard processes have been fully automated. Finance has gained time and capacity to consider and work with analytical-related questions. Finance is the co-pilot in the context of strategic development and appreciated as a business partner for operational functions. Now, it's time to define your future in the digital world.
Right. So this is the video which takes us through all the current trends which are happening in finance. Most of you must be experiencing that finance as a function, and the importance is slowly it can enhance as and when the new processes and new technology is being adopted. Now, what do you mean by adopting new technology by the chartered accountants for their offices and for their clients? So this is one typical process how usually the month-end closing, which is happening in every organization. So if you see, typically it starts from day one when you start preparing the journal entry, which is we pass all the accrual entries at the month end, which we start, and then we prepare a month-end close checklist. Then we prepare the account reconciliations, and day 7 we prepare the financials, which is typically balance sheet, P&L. Then we start analyzing it. We analyze it with reference to the budget, forecast. Then we prepare various reports, maybe working capital report. Then we prepare, forecast compared with the budget or forecast compared with the actuals. Then overall year view, and at the same time spend bridge we prepare, spend narratives we prepare, and then we publish it to the management in the form of a monthly business report. And then typically day 14 to day 21 we focus on all the compliances like filing the GST return and all other returns. And this is how typically the finance function works within the organization. Now, what is actually expected by the corporates, or what should be done even by the CAs? So those who are the owners and those who want the performance reporting to happen, how it needs to happen in today's world. In today's world, we need to automate each and every process. So we should be talking actually daily P&L, daily balance sheet, daily variance analysis, and everything should be driven based on the KPI, which is a key performance indicators. So since everywhere we are talking about online real-time system, and it becomes extremely important that we need to have some automation engine. Automation engine can be in the form of an integrated system, and also in the form of an integrated business analytical tool called as management dashboard, whereby we present to the management that what is happening today, so that any decision making, if it is going to take time of 1 month, probably we may miss the bus. So ideally, we should be talking only about the future, and past data should be leveraged for talking about the future, and all our system and the technologies, whatever we are going to implement, should be aligned. And unless and until we close the books of accounts on a daily basis, prepare the balance sheet and P&L on the daily basis, it becomes very important, because we cannot move from the reactive method of auditing and then putting some kind of the numbers and leaving it for the interpretation. So our importance can enhance only when we talk about a daily reporting, daily KPI, daily monitoring, daily variance analysis, daily P&L analysis, and this is all possible in today's world. So we need to implement that. Even within our CA offices, we need to have this kind of a report, which is a KPI which should be generated on a daily basis. And same way, we can also train our client. Most of the time it happens that client prepares the financials only at the end of the year. That also when statutory audit needs to happen, at that time only he sees financial. So we need to evolve to this space. So this is what is the expectation. Now it looks like nice, but there are a lot of hurdles which you have to pass through this. So I'm just going to present you some case study, how I evolved within the organizations for whom I work, from the traditional accounting model to continuous accounting model. Before that, I want to take you through all other areas which are actually impacting us, and based on which we need to get to the way where we want to reach. So you all are aware about this FCPA violation penalties, criminal and civil. It started with FCPA, and when we come to the Indian scenarios, I feel everybody will smile at this picture, but this is a fact. Today, AI is coming in picture. Then all laws getting integrated, all returns being populated automatically. Actually, the government is much ahead than even the corporates and from us, compared to what ideally we should have been ahead of them. So we have to get adjusted to the government system, whereas government has thought much ahead of us in terms of the digital transformation initiatives. So you see that taxpayer, he is being pulled by all the authorities today, because each and everything is monitored online and real-time basis through Aadhaar, PAN card linkages, the GST, automatically returns getting populated. Most of the department, they started talking to each other now directly through common portals. So I just wanted to take one case law or small case study. For example, if you don't do a proper import or proper export, how you get impacted? So let's say if you don't do proper import, definitely, and proper export, then definitely it impacts onto the redemption of license and bank guarantee retirement. And as soon as this redemption happens, the repercussions are the shipment gets delayed, the green channel clearances get on hold. DGFT, it tracks export obligations and licenses redemption. So IEC can go on hold. Cash flow loss will be there. GST, rebate claim, if we don't do proper export, we cannot claim rebate claim, which will result into the blocked input credit return mismatch. Bank, most of you are aware that this, after introduction of IDPMS and EDPMS, even directly on public notice, you can see even big company names which are getting flashed that they haven't done the compliance of EDPMS and IDPMS. So definitely those big compliances expect that whatever government benefits which you have taken, you need to give it back. Then special valuation branch, they will expect that you pay some kind of a recurring deposit while doing the clearances if you don't do proper import and export transactions. And ED, very famous. So for any kind of a famous, so just one import and export transaction not done properly can attract so many kind of issues. Now on this background, what is needed before we get into any kind of a automation, or we talk about continuous accounting model or continuous evaluation model? it is very important for us as finance guys that for each and every activity that is being done in finance, how it is linked to the operations. So what I have done is here I have tried to put entire activities which are being run in any organization, be it a manufacturing service or even within CA offices. I have tried to classify it into three parts. One is input, which is basically the data which is required for carrying out the processes, and then the process which is actually being carried out. And third is the output. So if we start understanding our CA offices or the corporates in this manner, it becomes very, very useful, because I have been using the word continuously that we need to connect operations or we need to be the business partner. So when we will be the business partner, when we are able to effectively connect input to the output. So I will take few examples here. For example, if you say any kind of a production entries and cost of goods sold reconciliation is being done by us, for our clients, the input which is required is the production and operation floor data, which is typically the bill of material and the consumption related quantitative input, and what is expected from this process by the management and as a finance guys, what we need to deliver is coming under output. So we need to definitely give the cost of goods sold control. So we are always looked as finance guys, how effectively you control the COGS through this process. Similarly, through inventory audit, which is a process, we take the stock transaction data, everything from stores, and that is how our efficiency is judged by how effectively we control the inventory. For payroll data processing, whatever which is being carried out by finance, we can say that typically month-end JVs which we pass for the salary. The input which is required is employee, HR, admin and other departments, their attendance and all that. And from there, what is expected from the finance is that we should be able to control the payroll. Similarly, there are a lot of other processes. Now, because of the paucity of time, I will just try to run it here. So spend reporting, definitely the input is AP transaction data, accounts payable transaction data, and we are expected to do the spend control. Similarly, we are performing the accounts payable reconciliations and we need to control the accounts payable. AR management, the data which is taken from commercial department, and the job which is expected from us is controlling the AR through aging. Then performance, AR based reconciliations, again sales order transaction data, we control the AR. Payroll, we are also expected that we pay on time, so employee satisfaction. Then fixed asset management, admin and system department, we are expected to do the FA control. From risk management perspective, we keep getting a lot of fixed asset transaction data, even transaction data for different type of raw material that we are expected to purchase for in kind of a transit policies. So we are expected to control the risk. Statutory audits, if at all we are doing the process, definitely it is all the compliance related data which we take and we facilitate statutory compliance. And then all kind of compliance data which is used for all tax representation. Finally, what is expected from us through this is that we have to take care of the organizations who is our client by doing the healthy tax compliance. And even for us, for CA offices, we need to ensure that all sorts of exposures which may come in the form of interpretative legislations that we need to diffuse. Similarly, from accounts payable and GL accounting, utility admin department, whatever data which we process, like for example, utility on-time payment, avoiding the operation disruption. So these are certain things. And then as a finance, we are supposed to be doing some standalone finance functions. Which are those? That company policies and procedure ownership, predicting MIS report, coordination with the different business units, budgeting coordination, treasury operations, and we are expected to give a big picture to the organization, to the management. We are expected to blow the whistle for any kind of a policy violation, generate the trigger, avoid surprises, budget controls, and smooth business operations is what is the expected output from us when we do these processes. Similarly, costing, we need to ensure that the right bidding happens and the right pricing happens. And through various accruals or which we typically call it as a search for unrecorded liability, which we carry out through the GL transaction data, we are expected that we should be recording the correct financial position. Now, let's go to the next slide. Any kind of the organization, if we have to go to the continuous accounting module, or we have to evolve and we have to reach there, as I said, any kind of an excellence, it is a long-term journey. You can't say, declare that, I have achieved excellence for my CA office or for my client, overnight or over 1 month and 2 months. It can differ based on the assessment 3 years or even 5 years process. As far as you are in that process, we should be okay. So these steps tell us that where are we when we talk about the financial management of the organization. So we have to evolve. Is the organization, when it comes to the processes, is it at level 1 or is it at level 2? Level 1 is startup based processes. Like as if a startup, a small company, how they will do the organization. Are the processes, each and every process done in that way? If yes, then we need to take it to the next level, level 2, which is control, where we need to improve the processes which are focusing on compliance and control. If they are already at level 2, we need to say that yes, let's take the organization or take our offices, if it is at level 2, to level 3, where we start focusing on measuring how resources are used and managed for efficient and economical use. Then let's say we will take it to the level 4, where it is more managed, where balancing efficient and economical use of resources with quality effectiveness of results achieved. So, and then last is the best process, which is optimization, where there is a continuous improvement and learning. So we have to evaluate our organization on this growth path. Where are we on each process, and how to do it in a structured way is what I will be showing it to you. Now, this is the structure which is designed by me. So what is this structure? Any kind of an excellence you want to achieve, first you have to start monitoring. What do you mean by monitoring? Each and every department, okay, each and every activity, you start recording. So either you record it in your SAP, Tally ERP, MFG Pro, BAN, QAD, or whatever it is, which is a monitoring, or you start recording and reporting it in Excel also, that's fine. Because the data is going to be very important for the next decision making. Once you start recording each and every activity, start measuring it. What do you mean by measuring? Start measuring it in terms of some kind of a KPI, like monthly EBITDA to sales as a KPI, return on equity as a KPI, fixed cost to sales as a percentage as a KPI, variable cost as a percentage to sales as a KPI. So start designing the KPI for each and every function. Doesn't matter, as I say, each and every operation has to finally get connected to finance. So please take the initiative in even designing the KPIs for operational areas, because finally operation is connected to finance. So you see where are the linkages. Once you start measuring, then start analyzing. How do you analyze? You start analyzing your KPIs, whatever you have started measuring, with past trend. So you can either, if you don't have the budgeting as a process, let's say, you do one thing like last 2-3 years, what has been the average KPI for that particular parameter. You can start with that. Then you take it to the more mature phase, that start measuring it with the budget. The actual, you start measuring it with the budget. Or you can develop one more mature stage that you start measuring it with the forecast, because budget is again prepared at the beginning of the year. Forecast is a continuous evaluation, and then design the report. Now in a report, typically start publishing it. For example, start publishing the spend report. When you are going to publish the spend reports, publish it in such a way that it gives the bridge. For example, the salary as per budget, let's say it is 2 crore and salary actual is say 1 crore. So maybe budget to actual, the deviation may be 1 crore, but there may be 10 crore rupees of increase reasons will be there, okay, and 11 crore rupees of reduction reasons may be there. That's why it might have gone down. So classify it properly that, okay, one is because of the volume change, how much has salary gone up and down? Because of the people leaving, how much salary gone up and down? Because of the inflation factor, how much salary has gone up and down? Because of some kind of a JV or accounting adjustment which we pass, how much is the salary which has gone up and down because of any other factors, how much it has gone up and down. Like that, prepare the breach for each and every spend, each and every balance sheet. You can start it with spend item, then get to the balance sheet item, then go to the working capital items. What has been happening into the working capital? Once you reach to this phase, start benchmarking. So see what is your competitor doing. Okay, or benchmark organizations, what they are doing. Today, there is data available for each and every industry in public domain. Then there are a lot of agencies who give you the benchmark data for that particular set of industry. We have a lot of agencies even within India, like CRISIL, ICRA. They give the benchmark indicators. Then there are a lot of benchmark data providing agencies in US called as the one which I was more using was Hackett benchmarking survey. So you can take that and start comparing your organization. Where are you when it comes to the benchmark parameters? And then you start improving on the KPI. The moment you start, the KPIs are improving, that means automatically it will start reflecting in your revenue and profit numbers. Don't stop there, because there are some people who are going to follow you based on that KPI. So you have to get into the continuous innovation model. So this is how you have to actually, this is the route, this is the road for the financial excellence journey. So you start, optimize metrics, analytics, industry best practices, productivity improvement initiatives, everything start converting it to KPI. And you need to actually integrate your accounting systems and other systems with this kind of a technology, which is simplify, optimize, standardize. Now, this is the theme or a philosophy. So what you need to do, you need to start about measuring the organization on 4 metrics: financial, process, controls, and people. These are the metrics you have to classify across your organization, based on which you have to measure. Like, financial metrics typically talk about like return on equity, EBITDA to sales, fixed cost as a percentage. Process specific metrics talks about, PPM, rejections. Control specific metrics talks about, controls and compliances with reference to the statutory obligations. People metrics talk about more like attrition rate, then, salary as a percentage of sales, or contribution as a percentage of sales. Once you define this, start measuring it, then evaluate whether those are, really benchmarked. Now, this is one case study how I designed the organization, the financial excellence for one organization. So what I did was very simple. I just listed down, if I have to connect operations to finance, what are the pain areas which this organization I will have to pass through. So I wrote down all the pain areas. Then I said how I will work on the pain areas so that I effectively start controlling the organization effectively to the finance, and started making this kind of a plan. So based on this plan, it gave me the journey, and then I aligned all the people of all the functions that based on this plan, I want to, take the finance function to be the most effective function. So here I said, okay, I need to start splitting the fixed cost into 4 parts, like what is the structural cost, what is the base cost, what is the step cost, and what is the semi-fixed, semi-variable. So this is a pain area. So what I did is the 100% controls I achieved. Then I said, in order to do it effectively, I will initiate the process of the spend reporting. So this is how I did it. And then why management should trust you if you want to do any kind of a financial excellence in any organization. You need to jot down the initiatives which you have taken in the organization, based on which organization will trust you, the management will trust you, and then they will tell you, okay, you are the fit person to carry out the financial excellence. So for example, for your client, you must have taken some kind of measures. So you have to jot down that, yes, we have taken these measures and we want to participate on and contribute in your drive for financial excellence. Now, I have identified that as a finance guys, any company, whether it is our CEO own office or for our client, we need to understand what is finance. So finance means, I feel these are the 18 areas we have to understand. So one area is like an enabler area, which I call it as like a foundation. Let's say you are constructing a building, your foundation has to be strong. So first you are going to check how are the accounts payable, accounts receivable, inventory management, general ledger and bank cash areas which are happening in the organization. First check those. Okay, if you are a CA, you are a CA, so within your practicing CA, then check within your offices how these areas are happening currently, accounts payable. If these areas are happening, the best possible way, and I'm going to tell you how to check each area. What is the best in accounts payable? What is the best in accounts receivable? First, fix this. Then go to the excellence of these areas, which is facilitator, which is taxation, closing means book closing, payroll accounting, costing, fixed asset and capex. Once you get the comfort on the facilitator area, then go to the next level, which is results, which is compliance area, check financial planning and analysis. Then check controls, all controls, your IFC controls, Sarbanes-Oxley controls, all sorts of like ITGC controls, how those are being managed. Then ERP and IT infrastructure. Then commercial processes, how effectively they are there, like IDPMS, EDPMS, all sorts of, purchases and sales, how those are effectively done. And then go to the super goals. So then you can venture into treasury and FX, how it is being handled. Like, for example, if you are dealing with a foreign client, how is he taking hedging and how is he managing the currency? And if you are a CA, then you say, are you preparing at least a forecasted cash flow? Are you preparing the cash flow based on the direct method or indirect method? Then you get into the revenue mode, and then you get into MIS. So what you have to do is you have to first assess yourself. Where are you on each of these areas? So I have just made some kind of an indicator chart here. So you can see that the external areas is like outer bound reflects 100 out of 100 score, and the inner circle, it indicates where are you on this radar chart. Like you are on 470, let's say, after assessment. So first understand where are you before you start jumping that, okay, I need to fix the process in costing, general ledger, fixed assets, accounts receivable. Before that, you understand where are you. Once you do that, try to, this will come something like this, that, yes, if I have to become a world-class organization, as far as the finance processes within my CA office or for my client is concerned, I need to first see where I am. So I'm at 470. When it comes to the, my processes, result-based processes, I'm at 25%, facilitator, I'm 26%. And as an organization, as a CA office, for me, I'm let's say at 26%, or my client is at 26%. Now, if you are at 26%, that means somewhere between start and crawl. So you have to see that you need to first crawl properly, then only you can walk. Once you start walking properly, then only you can run. So let's start, getting into this journey. So this is the first assessment which we have to do. And how to do this assessment is, we will be actually doing this assessment in my next session for our own offices. And I'll be giving you an assessment sheet where you need to plot it so that you will see it on radar chart, where is your office starting at high level. Now, we need to actually get into each and every area after this. So assessment is definitely the result of assessment of these areas, but we need to know in each area, what are the activities which are required to be done? Are we doing that? For example, if it's an inventory as an area, we have to assess it. Are we doing regular monitoring of the warehousing for our client? If we are doing it for the client, we'll ask this question to the client. Is client doing warehouse implementing? Are they, did they put any operation management system? Are they taking perpetual cycle count, periodical physical stock take? Are they doing reconciliations with the financial records on a monthly basis? How are they doing cost reconciliation? Are they doing it with the bill of material? Are they actually calculating material usage variance, product order variance, material mix variance? How are they monitoring? Because today consumption for a manufacturing company is at least 60 to 70% is the consumption. What controls they have there? Is your client actually calculating inventory days, ITR, aging report on a monthly basis? Purchase price variance, how analysis, is he doing it? Inventory valuation, how is he doing? And is he doing ABC categorization? Is he setting up the economic order quantity? So this is how we have to assess on the inventory. Then let's go to import. So we'll say that how is the import process happening? Is import invoice booking happening? Is there a three-way match? Is he doing the GRIR, SRIR reconciliations on a monthly basis? How is he doing bill of exchange acceptance? Is he performing accounts payable aging? Unrealized profit, how is he taking out if it's an intercompany stock? Is he using the forwarding contracts for the import? How is he doing the control account reconciliation? Is it sub-ledger based, or it's occasionally only during the statutory audit he is asking the statement? Then we will also check how is the accounts receivable function happening. So we'll check, how the export sales are happening. Is he passing export incentive on the accrual basis, or is export incentive entries are only passed on cash basis? For example, if you pass it on cash basis, you are going to lose the track definitely, because you are not going to review the balance sheet on a monthly basis. Realization entries, how those are passed. Bank charges booking, how is it done? Is bank reconciliation done? Control account, intercompany reconciliations. Like that, each area you will just try to assess. I'll just move it fast. Accounts payable, then you will see payment and treasury process.
So there's a question posted. If you could just attend to that once, please. There's a question posted. And there are a few more questions coming up, sir.
Right. So maybe I will take all these questions because I think there are some 10 minutes to go. And maybe all questions I will take it in 5 minutes. Is that okay?
Absolutely fine, sir. Not an issue. So what I'll do is, the moment I get the questions, I'll start just pasting it over there, and then you can attend all of them together, sir.
Right. Yeah. So just give me 5 minutes. I will end this session and I will take all the questions one by one. Right. So then payment and treasury function, definitely you will see, is your client taking care of all TDS, debit note settlement? Is he doing the fund position update, daily cash flow preparation, bank reconciliation? Fixed asset, you will check typically how is the CWIP accounting is being done, capex advance, disposal entries, how those are passed. Then control, how is it ensured? Capital budgets, is your client preparing capital budgets? And how is he carrying out the variance analysis? Asset master, is he created it? Taxation, you will check how is the withholding tax returns are being submitted, tax audit by department. Is he preparing the monthly compliance report? Compliance MIC is being generated or not? Then definitely risk management, you will check retirement management, how is being taken care of. Control tax and closing. So you will check, is your client doing monthly preparing? Is he preparing monthly financial statement? Or if you are a CA, you are a CA office, is it preparing a monthly financial statement? Typically, every month we have to do 4 things: balance sheet, P&L, indirect method cash flow, and working capital report. These 4 are must. Is it being done on a monthly basis? Fixed asset, depreciation entries, are they being passed? Monthly reconciliation is done. COGS entries, are they passed month on month? And how are the internal control checks related? Any reporting is done or any checks are being done? So based on this, the entire finance deliverable, we have to find it out. That you have to ask, what are the deliverable of a finance function? Most of the time we ask client, what are your deliverable? We judge a client, production department, we judge it based on how many units he is producing. Sales department, we judge based on, what has been his revenue and what has been his performance. Similarly, finance as a function, these are our deliverables, which are accounts receivable control, AP control, FA control, GL reporting, MIS reporting, compliances, avoid surprise, smooth operations, minimize tax exposure, and ensuring control. So these are our deliverables. So how effectively these deliverables are being run is what we are going to judge. Based on this, we will need to design our KPIs that what are the KPIs for which we are responsible as a finance as a function. And these are a few of the KPIs, and we are actually going to design KPIs in the next session for the finance function. And this is my last slide. So what gets measured gets done, what gets measured and fed back gets done well, and what gets rewarded gets repeated. Measurement is going to be the most important function here. And once we start measuring, then we'll start analyzing, then we start reporting, and then we will start benchmarking. Now I will stop the share session here, and I will take each of your questions. Okay. So the first question, in my view, finance department is eyes and ears of the organization. If top management ignore finance department, the organization cannot maximize the profit and achieve the planned growth, and also keep the door open for misappropriation of funds. Yes, sir, I agree with you 100%. The only point which I'm trying to make out here is, how do you show that importance of the finance function more effectively? Is when you are able to connect operations. It is a general misconception. Any organization you go, they say that yes, they don't ignore the importance, but usually the importance is given more to the sales and the operation guys. And this is fact. When it comes to the incentivizing, then they are the people who are incentivized more. Whereas we as a chartered accountant, when we put that, we need increase in the fees, they are not comfortable, right? So if we start connecting the operations to the finance function, our role as a chartered accountant will enhance a lot. And that's how we can gain the importance. Next, in my view, finance, okay, I think the same question is typed here. Okay. Are ERPs replacing CAs? No. ERPs are actually going to facilitate CAs. More and more use of ERPs you do, you will get into more analytics and insights for the client. So that's how ERP we should leverage it in order to avoid all administrative work or mechanical work. So it is actually going to help CAs to do more focused and more analytical job. Next, is work from home going to be new normal? What are its pros and cons? Okay, if work from home, definitely the pros and cons with reference to the digital transformation is our focus need to get enhanced to digital transformation, insights, analytics. That should be our focus. Whatever activities we are going to do from work from home, our value will be felt more when we are giving insights in the most structured way in the dashboard format. That's the answer to your question number 3. Next, digital data, how safe are they? Okay, this is again the question where definitely in digital transformation, you have to take care of the safety and security side of it. That's where the IT as an organization need to be matured. We need to also play the role in ensuring that at least there are controls which are designed. If you see the book which is published by ICAI, it is surrounding ICAI, all sorts of controls, IFC controls. It has one big list of what should be the IT general controls. So we have to see as a CA whether all those IT general controls are in place or not. If those are not there, then we have to blow the whistle and we have to tell them that yes, we need to get those on track. Any more questions here?
So that's it.
Yeah. Okay.
Thank you so much, CA Yogesh Kulkarni Sahab. Nice insights. And looking forward to see you again on 19th for the part 2 of this session. Very delightful, and wish you a very happy Holi, sir.
Yes. Same to you. Thanks to and for giving me this opportunity and SCA who have been supporting me since I can. I'm very glad and want to work my all fellow professionals in their helping them and their drive for excellence.
So we have in line our Vice Chairman for Committee on Economic, Commercial Laws and Economic Advisory, CA Hansraj Chugh. And he's here to conclude the session. I'll just give a small brief about CA Hansraj Chugh. Hansraj Chugh is a fellow chartered accountant, fellow company secretary, law graduate, and an insolvency professional. He has more than 3 decades of experience in the professional practice relating to indirect taxes, foreign trade law.
डॉक्टर साहब बड़ा इंट्रोडक्शन हो गया. अब हमें जो है अपने योगेश जी ने जो है इतना शानदार पढ़ाया, और हमारे जो दूसरे साथी जिन्होंने साथ दिया हमारा फर्स्ट सेशन के अंदर, तरुण जी ने, उनकी तारीफ करने दो. और हमारे जो मेंबर्स, जो पार्टिसिपेंट्स हैं, उनके बारे में कुछ बोलने दो. आपने मेरे बारे में काफी कुछ बता दिया.
Go ahead, sir. Please go ahead, sir. All yours, sir. Please go ahead, sir.
Thank you, brother. Thank you, Dr. Salim Khan Sahab. You have moderated very well. I can well understand though I entered into the only last, the way really Yogesh Kulkarni ji, the speaker of the second session, he brought the things. One can measure it, then only one can manage it. Without the measurement, the understanding, whatsoever is being done with towards the driving the financial excellence, in whether in the corporates or in the CA firms or otherwise in any organization, the most important factors which ultimately comes out to be the outcome of any institution is the financial power built in. It has been managed well. It has been brought all the parameters, whether it is the incoming things or outgoing, whatsoever has to be delivered for the good things to carry with is the image and the brand and the goodwill of the organization. If it timely is being paid, you bring so many goodwill. Same time, if you realize timely the receivables, that brings the whole of the ecosystem very complete. So, Yogesh ji, really, I appreciate the way you brought so many good things to the participants. I, on my own behalf of the committee, and on my behalf of my chairman, CA Dr. Rajkumar Adukia ji, I really appreciate and I'm very grateful and thankful to you for bringing out a good concept, good understanding, and the complete understanding by saying the measurable terms. So those are basically, that is the real picture, the practical approach by which we can bring excellence in the financial system of any organization. I'm very grateful and thankful to you. Really been, it's a kind of, such a big knowledge is being spread for the benefit of our fraternity. On behalf of everyone participants, I'm very grateful and thankful to you. Dr. Salim ji, though I will not be there since the starting of the program, but I hope so. The another part which was part of the program is the valuation of the securities under the Companies Act. I know this Tarun Mahajan ji is an expert into this area. He may have given the best out of his own understanding and the system available for the valuation side. I, on behalf of myself, on behalf of each and every participants, and on behalf of my chairman, Dr. Dhukia also, I'm very grateful and thankful to him in his absentia. I hope he is not there because his session is over and everyone is busy. So I'm very grateful and thankful to him also. And thanks to the Dr. Salim Khan Sahab, he's a part of the system. I'm very grateful and thankful to you. You have taken a lead. Best the moderation part you have taken over, and with the team available with us, Shalini Gulati and her team members in the committee, I'm very grateful and thankful to them also for bringing out the best in the ecosystem of the success of this very program. And last but not the least, who make the program success? The participants only can make the program success. I'm very grateful and thankful to each and every participants from the core of my heart, on behalf of the committee, on behalf of the chairman and me also, to each and every participants, and hope continuance of better learning, because this year this committee has taken a target under the able leadership and chairmanship of CA Dr. Our Adukia Sahab, Rajkumar Adukia ji, he wants all the aspects, wherever the newer things can be developed with, new opportunity can be brought in, new things can be carried with. So then this can only be the method. This can only be the method to bringing out the best of the speakers, bringing out the best of the system. Then only we can reach to and members can be more strengthened with. So this committee will be proactive with the newer ideas, well experienced of our chairman. I, at my personal level and at the committee level, I'm very thankful to the chairman for the bringing out the innovative things, which is out of the box thought process of our chairman. I'm very grateful and thankful to the chair, who has always been proactive, full of energy, with the newer ideas. Thankful to the chair in his absentia. Thanks to all, and hope and wish each one of you a very happy festival of the colors, the Holi also, which we all will be celebrating tomorrow and today also, because of the you see, like all parameters in the Indian festival says, these all festival has some kind of the significance in the life of everyone's life, and this color of festival is to bring joy and the happiness and the better energy level, the strength of the energy also. And wish each one of you a happy, colorful Holi, to all the participants, to all the speakers and the team there from the committee also, and the technical sports team also. Thank you, everyone. Thank you very much. Thank you, Yogesh ji.
Sir, बहुत अच्छा लगा sir. All kind words.
Thank you, brother.
Yes, we'll continue in the next session, part 2. Yeah. So can I leave now?
Yes, sir, you can leave. Thank you so much, sir. Thank you.